or it could also result in a change in a credit rating. Now, there is, in general, in any financial transactions, there are obligations of one party paying to the other a specified amount at a specified date. Right? Let's say in case of a loan, there is an obligation on the part of the borrower to pay the lender different sets of amounts at different points in time. Let's say the interest on a regular basis and principal at the end of the maturity period. So there is an obligation to make those kind of payments, and any kind of a default that is coming on any of those obligations, or even a change in the credit rating associated with the person. For example, the credit quality of a company has degraded. Obviously, the interest rate on the same should increase. But if I am not increasing the interest rate and the company is paying the same, then there is a risk that is associated. So that kind of a risk is also linked to a credit risk. So typically when we talk about the various types of instruments that fall under the category of credit risk, or where the credit risk typically comes into picture, I can categorize them into corporate debt, where we talk about the loans, corporate loans or bonds, where we talk about the loans that are raised by the companies, fixed and floating rate, the bonds that are issued by the companies to raise capital, again fixed and floating. So here we will be talking about their inability to pay, right, at specified points in time, specified amounts, or even their willingness to pay. So the default that can come out because of these corporate loans and bonds is one major source of credit risk. So from the corporate, there is a possibility of a credit risk arising. Then the next dimension that we should see here is sovereign, more associated with the government borrowings. Could be a central government, state government, at any layer. The borrowings that are done by the government, either by the issue of the various short-term bills or long-term bonds, that whatever is the default that happens on the same, we are classifying it as sovereign risk, which is also a major form of credit risk. Then the third dimension which I should see with respect to credit risk is the credit derivative products. See, the most common example being, let's say here, credit default swap. As we all know, the working style of a credit default swap, I would just like to quickly look at it. Let's say A has borrowed something from B. So there is an obligation for A to pay B, let's say the interest at some regular intervals and principal at the end of some period. Now, B is exposed more to a credit risk because this A can default on its payments. So B is exposed to a credit risk there. So what B can take is, it can try taking a protection from C by paying some premium to it. Now, what is this protection? If A defaults, C will be compensating B accordingly. That is what is the background behind the credit derivatives, or credit default swap, the more common form of credit derivatives. We have so many other forms of credit derivatives also, but here what we are simply saying is B will keep paying premium, let's say every year on an annual or semi-annual kind of a basis to C, and C's job is only when A has defaulted either on the interest or on the principal portion, that portion, or depending on the agreement, the entire amount, whatever it is, that would be compensated by C to B, which means B is protected from A getting defaulting, but B is incurring a slightly extra cost in the form of a premium. Now here probably the C, which is acting in the role of taking the risk of A to make B, to lessen the risk of B. This is where we are looking at risk transfer kind of securities. So in case of the risk transfer kind of securities, again, one party could still be at a risk depending on the credit quality associated with the underlying borrower. So that is one more area which we have to look at when we talk about a credit risk. And the final dimension that I am looking at is the structured products. We have seen today there are so many structured products that are coming up in the market, called, let's say, collateralized mortgage obligations, collateralized debt obligations, collateralized loan obligations, something on the lines of mortgage-backed securities, a structured form of asset-backed security. So, what are these structured products? It's a pool of mortgages, pool of loans, pool of bonds. They are packaged together and sold to a third party, and based on them, the pool of loans packaged, sold to a third party, against which this third party is issuing the bonds in the secondary market. So these are the bonds that are issued. Now, generally this third party, which has created the financial instruments out of the pool of loans, which has created those structured products, it is perceived to be default free. But what could very well happen is, if the number of defaults on this underlying mortgage is increasing drastically, then probably the value of these bonds is going to go down drastically, and there is going to be a write-off from the creditor's perspective. Even that is what we are talking about, an exposure to credit risk itself. So that is where we will be seeing credit risk can arise from a multiple dimensions, right from the basic corporate loans and bonds where we could see some kind of defaults or delay in the payments occurring, to the extent of credit derivatives and structured products where you could see credit risk present to a great extent, right? So which means our primary intention is to value the various credit risky securities. How do I value the credit risky securities? And how do I take the mitigation mechanisms for the same? Now, from that dimension, first thing I would like to understand is the difference between the book value and the market value of a security. Of any security, When I have to talk about the book value, it is purely the accounting based stuff. It has nothing to do with the market. Whereas the value, when we are talking about as a market value, the values are purely taken from the market, which means they are updated at regular intervals of time. Whereas these numbers generally they are historical. At the time when we have taken the loan, whatever is the amount we have taken, that is the value that we are representing. But that particular loan value today, if it has either gone up or gone down, that particular numbers are what are shown as a part of the market value. So generally this is one major difference. So when we are talking about this kind of a balance sheet, we call it as accounting balance sheet, whereas when we are preparing a balance sheet using this mechanism, we call it as economic balance sheet. So the assets, though in both of them the assets should be equal to liabilities plus owner's equity. Here the assets, we generally represent them as the liabilities plus owner's equity at that particular point of time t, which means the values are updated on a regular basis. Right? So from here on a regular basis we can try computing either the equity ratio, which is nothing but what portion of the total assets is the form in the form of equity, or sometimes people take it the inverse of the same, call it as leverage ratio. To what extent the firm is levered, total assets divided by total equity. The higher it is means the higher is the composition of debt and vice versa. So, from the purpose of valuation, it's always important for us to understand the market value dimension or a fair value dimension rather than looking at the bookish value. Now, but we all understand, I think, the differences between the equity and the debt. What we generally see is the debt investors losing, will start facing a loss after all the loss is absorbed by the equity investors. So, after the equity investors absorb all the loss that they can to the extent of their investment, after they absorb all the losses, so only after that the loss starts happening to the debt investors. That is the typical structure of risk taking in any capital structure. So the higher is the composition of the equity, a very rare chance that the debt investors will face any kind of a loss. But if the composition of the equity is much lesser, then the chances of loss for a debt investor are going to be much higher. So without getting too much into the debt and the